Hello and welcome to Inside ETFs. I'm Ramzan Karmali. Today we're looking at Japan-focused ETFs, and my guest is Shuntaro Takeuchi, Portfolio Manager at Matthews Asia. Since the Bank of Japan raised interest rates at the end of July, it's been a wild ride for Japanese funds. The biggest one out there, the iShares MSCI ETF, or EWJ, was no exception. That rate hike, combined with strengthened expectations for US rate cuts, led to the sudden unwinding of the carry trade, borrowing in low-yield yen to purchase high-yielding US assets. But does the subsequent recovery suggest that Japan's fundamentals are still sturdy? Well, to give his view on that and more, I'm joined by Shuntaro Takeuchi from Matthews Asia. His firm has an actively managed ETF, JPAN. Shuntaro, thank you so much for joining us. Well, let's start with those wild swings that we saw at the start of the month. What do they tell investors about the long-term sustainability of these funds?
Indeed, the Japan markets had a wild swing late July, earlier this month, after the BOJ raised rates. However, if you look at the earnings capability of Japanese companies, it still remains resilient. And also in terms of our strategy, which is US dollar denominated, a stronger yen is not necessarily a bad thing in our view.
Now, we've seen some governance changes with Japanese stocks. Are investors finally reaping the benefit from dividends at last in Japan?
I think the important thing here for Japanese companies gearing up their dividend payment and also share buybacks, which is at a record high, is that they are funding from a numerous amount of cash flow they have accumulated over the decade. So unlike the companies that are listed in the United States, where they actually borrow money to buy back shares, Japanese companies just need to tap their too much accumulated cash on their balance sheet to shore up their dividends and buybacks.
Now, I know your own fund, JPAN, is actively managed, but most funds focused on Japan are passively managed. Why is that?
In terms of case for active, Japan in our view, is a very good place for active investments because the largest constituents of the index, which is Toyota Motors, is only about 5% of the total index. So there's not a specific few companies that dominate the majority of the index itself, which leaves room for stock picking. Another thing is Japan is very unique in terms of opportunities that lie in terms of like multiple sectors. So it is just not tech, it is just not factory automation, but in construction, in cement, in like conglomerates, there are multiple opportunities we can engage with the company and actually benefit from the improvement in profit margins and also profit growth.
Now, have flows into Japanese ETFs sort of matched the market gains we've seen in the last 12 to 18 months?
If you look in the global context, Japan as a region is still very much underinvested. And also, if you look at the flows, there are inflows and outflows, but we don't see any like structural inflows as of yet to actually offset the decade-long underweight, which is a good position to be in if you are starting to invest from now, because the valuation multiples, despite the fact that the Japanese corporates has grown its profits for double-digit CAGR for 10 years, the valuation itself is still trading at give or take about 15 times, which is exactly the same as 10 years ago. So majority, if not all, of the returns that Japanese companies have produced over the past decade are pure profit growth. No multiple expansion, which as a new investor is a good place to be in because it's not a crowded trade.
So the last time Japan was sort of an investment hotspot was back in the 1980s when US and European investors could easily access the market. Now there's a lot more choice for them. There's China, there's South Korea, there's India. So where does Japan fit in this sort of pan-Asian investment strategy, do you think?
Regardless of the region, the important thing here is the corporate profit that are listed in the respective region set to grow over the medium to longer term. I think there is a meaningful perception gap among the investors that mix up Japan's GDP growth, which is 0.5%, and strong corporate profit growth. Even if the GDP is growing at 5 to 6%, if the company profit growth are underperforming that, then we would rather want to invest in areas that have robust earnings growth on the corporate profit side. And that's where we focus on. And if you basically compare in the Pan-Asian context, Japanese corporate profit growth are actually stronger than many of the other emerging market regions.
Shuntaro Takeuchi from Matthews Asia, many thanks for your time. And that was your look at Japan-focused ETFs. I'm Ramzan Karmali, and this is Reuters.